Are you lying awake at night worried that a market crash in 2026 will wipe out your retirement savings? I completely understand that fear. When I look at the headlines, the warnings, the predictions, it can feel overwhelming. But here's what I've learned after years of studying market cycles and investor behavior. Even if 2026 brings a significant market correction, it doesn't have to destroy your investments or your retirement. In this video, I'm going to walk you through exactly why so many experts and analysts are predicting a market crash in 2026. More importantly, I'll show you what that actually means for your personal situation and how you can invest with confidence regardless of what this year brings. I want you to feel secure, not anxious. I want you to understand the real risks and the real opportunities. Let me start by addressing the warning signs head-on. These are the same indicators that have so many retirees worried, and I want to show you whether they're actually as dangerous as they appear to be. Take a look at this chart from NASDAQ that I've been analyzing. It tracks the valuation of the S&P 500 over time, specifically looking at price-to-earnings ratios. This metric tells you how expensive stocks are relative to the actual profits companies are generating. When I first saw this data, even I had to pause and think carefully about what it means. Here's what stands out immediately. Valuations recently reached their second highest level in over 150 years of market history. Now, if you know anything about market patterns, you understand that historically, a spike like this tends to set off serious alarm bells among investors and financial professionals. Let me give you some context that might sound frightening at first. The first time valuations climbed this high was in 1929. And what happened right after that? We experienced the worst market crash in United States history. During the Great Depression that followed, the Dow Jones Industrial Average fell a staggering 89%. That's the kind of number that makes anyone nervous about their life savings. The next peak in valuations came in the year 2000, right at the height of the dot-com bubble. What followed was the dot-com crash, when the tech-heavy NASDAQ index lost nearly 80% of its value. Entire fortunes were erased, retirement plans were devastated. So when I see today's valuations sitting at those same record levels, I completely understand why so many people are anxious. Add to that the constant media headlines screaming things like, "There's no mistaking what comes next for stocks," and it's no wonder retirees are losing sleep. But here's the critical question I want you to ask yourself. Does this automatically mean a crash is inevitable? Does high valuation always equal disaster? Let me show you something that might surprise you. I want to take you back to 1996. This is a crucial example that most financial commentators overlook. At that time, valuations had climbed to their highest point since before the Great Depression. The markets looked expensive by historical standards. The Federal Reserve Chairman at the time, Alan Greenspan, gave a famous warning that became part of financial history. Greenspan cautioned that investors might be getting carried away with irrational exuberance. Those two words, irrational exuberance, sent shockwaves through the investment community. Many investors heard that warning and thought, "This is it. The market is about to crash. I need to sell everything and get to safety." But look at what actually happened to the S&P 500 in the years that followed. Right at the point where Greenspan gave his speech, you know what the market did? It didn't crash. In the 3 years following that warning, the market nearly doubled in value, delivering an average annual return of almost 26%. Think about that for a moment. If you had sold all your investments just because the headlines looked scary, just because valuations seemed high, just because an expert issued a warning, you would have missed one of the strongest market runs in history. You would have locked in whatever modest gains you had and watched from the sidelines as the market soared. This teaches us a profound lesson. High valuations don't automatically signal an imminent crash. They're a piece of the puzzle, yes, but they don't tell the whole story. Now you might be thinking, okay, but that was the 1990s. Why does that matter for me and my situation in 2026? Great question. Let me show you why the comparison is more relevant than you think. I've been studying this chart closely, and I want to share what I've discovered. It compares the recent strong market returns to the run leading up to the dot-com burst. At first glance, when you look at these two lines on the chart, they look almost identical. This is precisely why so many analysts and commentators are predicting a crash is imminent. But when you zoom in and really examine the data, does it actually look that catastrophic? Let me break this down for you using data from Fidelity's research team. This specific chart shows the Nasdaq gains during the dot-com era compared to today's market environment. The green line on this chart starts in 1994, which was when Netscape, the first major web browser that brought the internet to mainstream users, was released. That marked the beginning of the internet revolution that would eventually lead to the dot-com bubble. The black line starts when ChatGPT was released and kicked off the current artificial intelligence boom that we're experiencing right now. Here's what fascinates me about this comparison. If today's AI-driven market run were to match the trajectory of the dot-com surge, it could potentially continue for several more years. But even more importantly, when you actually compare the magnitude of the gains, the current run looks surprisingly modest compared to what happened during the dot-com era. The dot-com bubble saw exponential, unsustainable growth. We had companies with no profits commanding billion-dollar valuations. Today's AI companies, while expensive, are generally generating real revenue and real profits. The fundamentals are different. But here's the thing. The dot-com comparison is just one data point. If you're genuinely worried about a crash hurting your retirement, we can't just look at one historical example. We need a comprehensive view. To really understand whether a significant drop might be coming, I've analyzed how today's market run compares to every major bull market in modern history. Not just one, not just the dot-com bubble, all of them. This visualization I'm showing you displays every bull market since the Great Depression. Think about that. We're looking at nearly a century of market data. The dark red bars represent how long each bull run lasted. The orange bars show how much they gained during that period. Now here's where we are today. The current bull run started in October of 2022, coming out of the bear market that year. What do you notice when you look at this in context? First, many of the past bull markets grew to much higher levels than where we are currently. Second, many of them lasted far longer than the current run has lasted so far. When you calculate the average across all these bull markets, you get a run that lasts nearly 5 years, with total gains exceeding 170%. So, what does this tell us? The current market run is not only far smaller in terms of gains compared to many major historical bull markets, but it's also shorter in duration than the average. We're not at some unprecedented extreme. We're actually below historical averages. This doesn't guarantee the market will keep rising, of course. Markets don't work on guarantees. But it does mean that just because we've had a couple of strong years doesn't automatically mean we're at the absolute top, or that 2026 has to be the year of the next major crash. Now, here's something crucial I need you to understand. Even though the data I've shown you is encouraging, your retirement isn't going to last just a few years. If you're retiring today or already retired, you need to plan for your money to last potentially 30 years or more. That's why we can't stop our analysis with just these shorter-term bull markets. We need to zoom way out and look at the truly long-term market cycles that will determine whether your retirement is secure or not. This chart from Fidelity's research shows these major generational cycles going back nearly 100 years. We're talking about cycles that run from major generational lows, the real market bottoms, to generational peaks. These are the cycles that define entire eras of investing. On average, these massive cycles last about 30 years. 30 years. Now, if today's cycle were to follow the same historical pattern that we've seen in the past, it would potentially run all the way into the year 2039. Think about what that means. Whether you examine the short-term data or the long-term cycles, everything points to the same conclusion. 2026 doesn't look like the financial disaster that the headlines are warning you about. But, and this is a critical but that I need you to hear, here's the real risk that keeps me up at night on behalf of retirees like you. Even when the market rises steadily for decades, most investors never actually capture those gains in their own accounts. This is the tragedy I see play out over and over again. It's not because of market crashes, it's not because of bad luck, it's because of one silent mistake that derails more retirements than any market crash ever has. Let me show you exactly what this mistake is, and more importantly, I'll give you a simple, practical way to avoid it in your own investing. This visualization compares how different investments performed over a 20-year period. Look at the green bar first. That's the S&P 500. It averaged over 8% per year during this period, one of the best performing major assets you could have owned. Now look all the way to the right at the orange bar. That represents the average investor, real people like you and me, managing their own retirement accounts. They earned just 2.1% per year. That's not even enough to keep pace with inflation over time. Stop and think about that gap. The returns were there, the market delivered, but the average person captured only a tiny fraction of those returns. Why? What happened to that missing 6% per year? This chart tells the story with brutal clarity. When the market is rising and everything feels safe, people feel comfortable buying. They're adding to their investments. When the market dips slightly, they tell themselves to stay patient. This is just a temporary setback, they think. I'll ride it out. But when that drop continues, when it keeps going down day after day, when the financial pain becomes truly uncomfortable and the fear becomes overwhelming, that's when most investors sell. That's when they lock in their losses and step to the sidelines. And when these fear-driven decisions repeat themselves over time, over multiple market cycles, it leads to what behavioral finance experts call the behavior gap, the painful difference between what investments actually return and what investors actually keep in their pockets. It's the devastating pattern of buying high when you feel confident and selling low when you feel afraid. This is why so many people miss out on the returns that were sitting right there in front of them the entire time. So, the question that should be burning in your mind right now is, how do I make sure I don't become the average investor? How do I capture the returns that the market offers instead of sabotaging myself? Let me take you back to those moments we looked at earlier. Imagine you had invested in the S&P 500 right when Federal Reserve Chairman Alan Greenspan gave his famous irrational exuberance warning in 1996. Think about everything you would have lived through as an investor. You would have experienced two separate 50% market crashes, the dot-com bubble bursting and the 2008 financial crisis. You would have lived through the September 11th attacks and the market panic that followed. You would have endured multiple wars, a global financial crisis that nearly collapsed the entire banking system, a worldwide pandemic that shut down the economy, and more smaller corrections than anyone cares to remember. Through all of that chaos, all of that fear, all of those moments when it felt like the smartest thing to do would be to sell everything and hide under your bed, if you had simply stayed invested, your average annual return would still be just shy of 10% per year. And here's something even more remarkable. Even if you had the worst possible timing and invested at the absolute peak of the market in 1999, right before the dot-com crash devastated tech stocks, your long-term annual return through today would still be more than 8% per year. This is the power of staying invested. This is why discipline matters more than market timing. But why is staying invested so incredibly difficult? It's not because you're weak or undisciplined. It comes down to something neuroscientists call loss aversion, and it's hardwired into your brain. Research in behavioral finance has shown that losses feel approximately twice as painful as equivalent gains feel good. If you lose $10,000 in your portfolio, the psychological pain you experience is roughly twice as intense as the pleasure you'd feel from gaining $10,000. Your brain literally treats a drop in your portfolio value like a physical threat to your survival. When that fear response takes over, when your amygdala starts firing warning signals, it pushes you to step out of the market at exactly the wrong moments. It's not your fault, it's how we're evolutionarily wired. But jumping out at the wrong time is the single biggest mistake that can ruin your retirement. Let me show you with data exactly what that mistake costs you. This chart shows the best and worst single days in S&P 500 history. Everyone remembers the terrible days, the dot-com crash, the 2008 financial crisis. Those memories are seared into our collective consciousness. But here's what most people completely forget or never realize in the first place. Some of the strongest single days in market history happened immediately after the biggest drops. In fact, 7 of the 10 best single days in the market occurred within just 2 weeks of the 10 worst days. Think about the implications of that. The biggest gains happen right when fear is at its peak, right when it feels most dangerous to stay invested, right when every instinct is screaming at you to sell and get to safety. Now, you might be thinking, okay, but how bad could it really be to miss just 10 good days out of thousands of trading days over the years? This data shows the impact, and it's shocking. Missing just the 10 best trading days over the last 35 years didn't just slightly lower your returns, it cut them by more than half. More than half. This is why staying invested matters so profoundly. Most of the gains that make a comfortable retirement possible happen during the moments that feel the absolute worst. The moments you're most tempted to sell are precisely the moments you most need to hold on. But here's the challenge that's unique to your situation as a retiree or soon-to-be retiree. When you're working and decades away from retirement, you can afford to just grit your teeth and wait out market downturns. You're not withdrawing money. You might even be adding to your investments during the dips. But when you're retired, you can't just wait it out indefinitely. You need money from your portfolio to pay your bills, to live your life, to enjoy your retirement. You can't survive on hope and patience alone. You need a concrete strategy that keeps you invested confidently, even when the market isn't cooperating. Let me show you 2 powerful yet simple strategies that can protect your retirement and help you invest with complete confidence in 2026 and beyond. Think about trying to eat healthier. Let's say your weakness is cookies, and you find yourself raiding the cookie jar every night after dinner. What's the easiest solution to that problem? Is it developing iron willpower? Is it mentally forcing yourself to resist temptation every single night? No. The easiest, most effective solution is simply not keeping cookies in the house in the first place. Remove the temptation entirely. Retirement investing works on exactly the same principle. The easiest way to avoid panic selling during a scary market drop isn't to develop superhuman emotional discipline. It's to structure your portfolio so you don't experience the biggest, most terrifying drops in the first place. You reduce the temptation to sell by reducing the severity of the declines you experience. But how do you accomplish that while still staying invested and capturing long-term growth? The answer is strategic diversification. This visualization compares the S&P 500 with a properly diversified portfolio during some of the most stressful market declines in recent history. Pay close attention to these numbers. During the dot-com crash, the S&P 500 fell nearly 50% from its peak. That's half of your money disappearing. And it didn't recover to its previous high for more than 4 years. 4 years of waiting, hoping, wondering if it would ever come back. But look at what happened to the diversified portfolio during that same period. It fell only about 18% and had fully recovered to new highs in just 8 months. 8 months versus 4 years. That's the difference diversification makes. During the 2008 financial crisis, arguably the scariest financial moment since the Great Depression, the S&P 500 fell 55% and took more than 3 full years to recover. Many investors who sold during that crash never came back to the market. They missed the entire recovery. The diversified portfolio during that same crisis dropped about 36%. Still painful, absolutely, but it recovered to new highs in just over a year. Do you see the pattern? Instead of forcing yourself to white-knuckle your way through the deepest, most terrifying part of every major downturn, staying properly diversified smooths out the experience. It makes the journey more bearable. And when the journey is more bearable, you're far more likely to stay invested and capture the returns you need. But here's something critical that even well-diversified investors often miss. Even if you start with a perfectly balanced, diversified portfolio, it can quietly become much riskier than you ever intended, unless you remember one crucial step that most people overlook. Look at this chart carefully. It shows two portfolios that both started with the exact same allocation, a simple 60% stocks and 40% bonds. This is a classic moderate allocation that many retirees use. The gold line represents the allocation most people think they maintain throughout retirement. It stays steady, balanced, diversified, year after year. But the blue line shows what actually happens to your portfolio without any maintenance. Over time, as stocks naturally grow faster than bonds during bull markets, your portfolio quietly drifts away from your original plan. After just a few strong years in the stock market, you can find yourself at nearly 80% stocks without even realizing it. And here's why that drift can be absolutely devastating for your retirement. Look at what happened to the blue line during the 2008 market crash. Because that portfolio had drifted so heavily into stocks, far more aggressive than the owner intended, the market crash hit it with full force. What should have been a manageable downturn turned into a far deeper, much more painful drop. That's the kind of severe decline that causes people to panic and sell at the bottom. It's the same destructive behavior that created the behavior gap we talked about earlier. It's how people turn temporary market declines into permanent portfolio losses. Here's how you prevent that dangerous drift from happening to your portfolio. The solution is elegantly simple. It's called rebalancing. When stocks have a great run and grow larger than your target allocation, you sell a small portion of what's high. When bonds fall behind and shrink below your target, you buy a little of what's low. This brings your portfolio back to the mix you originally planned. It keeps your risk level steady over time. What does this accomplish? When you keep your risk level steady, you keep your emotions steady. And when your emotions are steady, you stay invested. You remain confident. You don't panic and sabotage your own retirement. Rebalancing forces you to do what every successful investor knows but finds difficult to execute. Sell high and buy low. It's automatic discipline built into your investment strategy. Now you understand why a market crash in 2026, even if it happens, doesn't have to threaten your retirement. You know how to build and maintain a portfolio that can keep you invested, protected, and confident through whatever market conditions come next. You've learned that high valuations don't automatically mean disaster. You've seen that the current market run isn't as extended as many people fear. You understand the devastating cost of the behavior gap and how to avoid it. You know the power of diversification and rebalancing. If this video gave you more peace of mind about 2026, please hit that like button. It really helps the channel. And make sure to subscribe and turn on notifications so you don't miss out on upcoming videos. Thanks for watching, and I'll see you in the next one.